Imagine walking into a store to buy a simple toaster. It's a good toaster, usually costs you 20 bucks. But suddenly, the clerk slaps a shiny sticker on it that says, "Powered by AI." Overnight, the price tag jumps to $10,000, and people are fighting each other just to hand over their life savings to own it. It doesn't cook the bread any faster, but the promise of what it might do one day has turned a kitchen appliance into a luxury asset. This isn't just a funny story. It's exactly what's happening in the market right now. Behind all the noise and headlines, there is one single, massive figure that should stop you in your tracks: $350 billion. That's the valuation a single AI startup named Anthropic is reportedly chasing, nearly doubling its price tag in just 4 months. We've reached a point where the hype has become so heavy it threatens to pull the entire market into a black hole. You might be looking at your portfolio today and seeing green, thinking you're safe from this madness. But look closer. Most of that growth is likely coming from just 5 or 6 giant tech companies. While you think you're standing on solid ground, you're actually on a thin sheet of ice. If this AI fever breaks, your hard-earned savings could evaporate faster than you can hit the sell button. Most investors are walking blindly into this trap, but there is a secret strategy, a safety hatch, that smart money is using right now to protect their billions while the public chases the hype. I'm going to reveal exactly what that asset is and how it can save your wallet later in this video. But knowing there's an exit doesn't help if you don't know how to stop the current bleeding. We aren't going to wait for a crash to protect you. There is one move you need to make right now. Open your brokerage app and check how much of your money is tied to just a few tech names. If more than 30% of your total savings is sitting in just technology stocks, you aren't an investor anymore. You're a gambler at a high-stakes table where the house always wins. To fix this immediately, consider moving a portion of your tech-heavy funds into an equal-weight ETF, like ticker RSP. Think of it like a boat, where every passenger is forced to sit in their own assigned seat. It ensures that even if one giant jumps overboard, the boat stays level. It's the simplest way to build a protective firewall around your savings. Why is this move so critical? Because the market engine is currently completely unbalanced. If that giant wheel, the AI tech sector, hits a single pebble of bad news, the whole car flips. By shifting to an equal weight strategy, you are essentially putting 4 solid, even tires on your vehicle. It might not feel as flashy during a rally, but it's the only way to reach your retirement goals without a total wreck. Knowing your portfolio is safe today is vital, but it is useless without opening the hood to see exactly why the engine is making that clicking sound in the first place. Now that you've applied first aid to stop the immediate bleeding, we need to understand the hidden mechanism that's driving these prices into the stratosphere so you don't get trapped again. Think of the current AI market this way. You want to buy a house. Normally, you pay for the roof, the walls, and the quality of the school district. But today, people are paying 10 times the price for houses in the AI neighborhood. Not because the houses are better, but because they heard there might be a massive gold mine buried in the backyard. The problem is, the gold hasn't actually been dug up yet. Companies are spending billions on chips and power. That's the digging process. But the actual profit, the gold, is still just a dream for most. You are being asked to pay the gold mine price today, while the company is still just struggling to pay for more shovels. History has a way of repeating itself, and we've seen this movie before. Back in the year 2000, it was the internet. People said, earnings don't matter anymore, only clicks matter. They were right about the internet changing the world, but they were tragically wrong about the price they paid for it. When the hype faded, the crash wiped out trillions in savings. At Sketching Finance, we draw these patterns so you can recognize the traps before they close on your wallet. If you want to keep your head cool while everyone else is chasing shadows, make sure to subscribe. We simplify the complex so you can stay in control of your financial future. Now, knowing the past is essential, but it is useless without a plan for the future because the road ahead just split into 2 very different directions. So, we stand at a fork in the road. If the path turns left, we see the bull case. AI actually starts saving companies 30% on their costs, like a machine doing the work of 10 employees. If that happens, these $350 billion valuations might actually be cheap in the long run. In this world, your balanced portfolio will thrive as the whole economy gets a massive boost. But if the path turns right, we hit the bear case. What if the gold mine is empty? If companies keep spending billions but can't find a way to make customers pay for it, the bubble pops. This is why the smart money is already buying insurance. They're using something called put options, which is just a fancy way of paying for a safety net that protects them if the market drops 20% overnight. Remember that safety hatch I promised to reveal? While the crowd fights for the last overpriced AI stock, big institutions are quietly moving their money into defensive value sectors like healthcare and utilities. These are boring companies that people need, whether AI works or not. You still need medicine and electricity even if the chatbots go silent. These assets, like the XLV or XLP funds, are your insurance. They won't make you a millionaire overnight, but they are the exit door that keeps you wealthy when the hype fades. They provide the rock-solid foundation your savings desperately need right now. But even a solid foundation can't survive if we ignore the one physical thing that every AI needs to stay alive. Let's recap our journey today. First, stop the gambling. Limit your total tech exposure to 30% of your portfolio. Second, use equal weight funds like RSP to give your money a solid foundation. And third, buy your insurance now. Look at healthcare and consumer staples while they are still on sale. Don't wait for the fire to start before you try to buy a fire extinguisher. Investing isn't about being the luckiest person in the room, it's about being the most prepared. By following these sketches, you're not just watching the market, you're mastering it. Subscribe to Sketching Finance to stay ahead of the curve and keep your savings growing safely. But here is the missing link that could break everything. All these trillion-dollar AI dreams share one fatal weakness. They need massive, almost impossible amounts of electricity. And right now, the world's power grid is failing to keep up. Big tech isn't just buying chips anymore, they are starting to buy entire power plants. Why is Microsoft betting your future on nuclear energy? We'll sketch that out in our next video. You won't want to miss how the power grid is the real winner of the AI war. See you in the next one.